So the Federal Reserve meeting recently wrapped up September 17th, and the outcome was a big shift. So they did vote to cut rates by 25 basis points, bringing the effective federal funds target range down to 4.75 to 5%. Now, a single cut wasn't surprising. That's what markets expected, but here's the shocking part. The Fed also projected 2 more quarter-point cuts this year, one in October and one in December. Now, that means 3 cuts in total for 2025, a much more aggressive path than they originally laid out in June. Now, let's take a look at the updated summary of economic projections. In June, the Fed forecasted the GDP would grow 1.4% this year, and after this meeting, they revised it up to 1.6. And on unemployment, they left their forecast unchanged at 4.5% by the year's end. And right now, the unemployment rate is at 4.3. So they're signaling the labor market will keep weakening from here. And on inflation, the Fed's preferred gauge, PCE, is projected to close the year at 3%, the same forecast they made back in June. Now, currently it sits at 2.6%, meaning they expect inflation to tick back up. And as for core PCE, which strips out food and energy, they projected a 3.1% at year's end versus the current 2.9. So the Fed expects the economy to cool, inflation to heat back up, and jobs to weaken, and their solution is to cut rates aggressively. Now, markets got the message loud and clear. Before this meeting, there was a 65.9% chance of 2 more cuts this year after the Fed's update that jumped to 82.6. In other words, traders now believe the Fed is locked in. Now, let's turn to the press conference. Powell was asked an obvious question. Why cut interest rates when inflation hasn't returned to the 2% target? His answer? The Fed's focus is now on jobs. He pointed to their dual mandate, stable prices at maximum employment, and he said the labor market risks outweigh the inflation risks.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the 2 goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
But here's where it gets uncomfortable, because Powell also admitted the Fed doesn't expect to hit its 2% inflation target until 2028. That's 3 years away. Now, reporters pressed him on whether that hurts the Fed's credibility, since for almost a decade now, they've been forecasting 2% just 2 years out.
Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Now, Powell stressed that policy decisions will remain meeting by meeting and data dependent, but given the new projection, it's clear that the Fed is already leaning towards multiple cuts. Now, another question. Could we see a bigger move like a 50 basis point cut and Powell pushed back hard, saying larger cuts only make sense when the policy is way off track or in an emergency, which, in his view, isn't the case right now.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
And finally, Powell was asked whether cutting rates with the stock market near all-time highs risks fueling a bubble. His answer? The Fed doesn't see financial stability risks as elevated. He pointed to strong household finances and healthy banks.
This rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate, and I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
So here's the bottom line. The Fed cut rates by 25 basis points, which is 0.25%. He set the effective federal funds rate to 4.75 to 5. He signaled 2 more cuts this year, nudged growth forecasts higher, left unemployment predictions unchanged, and admitted inflation won't return to 2% until 2028. And most importantly, Powell made it clear that the Fed is now prioritizing jobs over inflation. Now, let's talk about what happens after a Fed meeting like this, because that's where things get even more interesting. So, when the Fed restarts a cycle of rate cuts, history gives us a roadmap. 1 month after the first cut, the stock market doesn't usually move much. On average, the S&P 500 is just up 0.1%, with a median of about 0.4, which is basically flat. But as time goes on, this picture changes. By mid-December, history shows us a 77.3% chance that the market is higher than when it was on September 17th. And by mid-March, the probability is still over 72%, with an average gain of about 3.4% and a median of about 5.5%. And here's the real shocker. Going back through history, in every case where rate cuts began with the market near all-time highs, the market was still up 1 year later, 100% of the time. And the average gain was nearly 14%, with some years seeing gains of 20 or even 30. Now, does that mean the stock market can't fall in the short term? Absolutely not. We could still see a drop of 20 to 25%. But here's the key. History shows that when that does happen, the Fed steps in, prints trillions, and engineers a V-shaped recovery. The stock market is essentially too big to fail. Now, this also has major implications for the US dollar, because rate cuts weaken a currency. Now, the US dollar has already had its worst first half of the year in more than 50 years, and history shows us it could fall even farther. And that's a tailwind for gold, silver, and especially Bitcoin. As more money's printed, it takes more dollars to buy the same ounce of gold, or the same amount of food, housing, or energy. That's inflation in action. It's why many investors believe that hard assets thrive in this environment. So what's the takeaway? Stay invested, but stay smart. Don't over-leverage, because short-term crashes can wipe you out before the recovery kicks in. Keep a cash cushion for expenses and big purchases, but don't hold excessive cash because inflation erodes it over time. So the Fed has made its move. They're cutting rates and they're planning on continuing to do so. And history shows us what usually follows. And if you see corrections, treat them as opportunities to buy the dip, because in this system, with trillions more dollars set to flow in, assets are designed to keep going higher. Now, if you got any value from this video, make sure to like, subscribe, and share this with somebody who needs to hear it. Thanks for watching, and I'll see you on the next one.